Welcome to our class in financial accounting, where we're going to discuss issues to do with accounting for basic accountants. So we're going to look at unit 1, 2, 3. So the structure of this unit is as follows. We're going to define what financial accounting is, its purpose, the types of organizations that are there, and the users of financial accounting information. So what is an account? An account, we can use one word, which is a synonym. An account is a record or a report or a statement. So we can trace accounting far back to the Bible, where Romans 14 verse 12 writes to say each one of us will give an account of oneself to God. So to account is simply to give a record or a report. So in financial accounting, we are going to look at custodians of organizations like directors and managers who report to the shareholders to give an account of how they manage the resources on behalf of the shareholders.
Sorry, Mr. Collins. Yeah. Hello?
Yes, I can hear you.
Yes.
So the definition of financial accounting is as follows. It is a classification, the recording of monetary transactions of an entity in accordance with established concepts, principles, accounting standards, and legal requirements and their presentation by means of an income statement, a balance sheet, a cash flow statement during and at the end of an accounting period. This is according to the CIMA official terminology of financial accounting. Now, to delve in this definition, it has a lot of components that summarize your whole syllabus. So the classification here in financial accounting will help us know the key classifications of accounts, like what is an asset, what is a liability, what is an expense, what is a gain, what is a liability. These are classifications. So accounting will help us understand these important terms. An asset is simply what a business entity owns. A liability is what a business entity owes. Gains are revenues. Expenses are what we spend, except that the expenses come in as a capital expenditure or revenue expenditure. We'll look at those ones in depth. So I'm trying to break down this definition of accounting. Accounting also involves recording or posting of transactions. Every entity is called a transaction. Now, these transactions have a form in which they are supposed to be posted. So we use a monetary form. This monetary form is what we're going to use as a concept called the monetary concept. So whenever we're dealing with financial accounting, we don't deal with money in terms of goods, but in terms of currency. So financial accounting also takes account of entities that are entered. Any entity or transaction is entered in established books, like the trial balance, the income statement, the balance sheet, cash flow statements, using accounts that are already established. We call those accounting standards. And these accounting standards are subjected to legal requirements. For instance, a limited company is by law required to submit their annual reports, financial statements in the press. So that is a legal requirement. And the format of the presentation is also prescribed for them. So in a nutshell, this is what the definition of financial accounting is. So the purpose of financial accounting is to establish the following. Number one, to give us what the company owns. This is called an asset. To also establish who owns the company. These are our debtors. Our debtors owe us as a company. to also establish how this company is financed, maybe by shares. It is a limited company. It also establishes the performance of the company, where we're going to establish our ratios to see whether we are progressing or not. And finally, who the company owes. So we're going to look at our creditors. Now, the purpose of financial accounting is required for a variety of reasons. Number one, it is just to fulfill the legal requirements. These legal requirements are set up in every country, in every jurisdiction, so that people could know whether you are making an account of the resources of that particular nation in a manner that will benefit the nation at large. So that is a legal requirement. Also, the purpose of accounting is mainly to assist managers, who are the internal users of accounting information, to plan, to control, and to make decisions. So accounting is of interest to the business and to the users. So we're going to classify these as internal users and external users. So these users of accounting information, like you and me, are custodians of financial accounting information. So internal users include the managers, include the employees, include the directors. Within the firm, employees want to know whether they can bargain appropriately for an increase in their wages or salaries. Trade unions want to also know whether they should bargain for an increase or not. The managers for planning and control. Externally, also the users will be interested in financial accounting information, like the shareholders, who are the owners, to see how much dividend they must cry for. The potential investors and shareholders also want to see their investment, whether it's being well used. The press want to give a report of the accounting. The government, through the inland revenue, like ZRA in Zambia, wants to know what tax are paid. The suppliers and the banks want to know if they are to give us loan capital, whether we are reliable enough to repay it. So this is about the users. There are types of business entities that we need to know. There are business entities that are recorded under trusts, others as cooperatives, others as business names, others as partnerships, and companies. So these, especially in Zambia, stipulate the structures that businesses are recorded under. So we have a sole trader. This is a one-man business who can employ one or two people, and he makes all the decisions himself and enjoys all the profits. Unfortunately, he has unlimited liability, meaning his Nkongole would go to as far as what he owns. Other disadvantages is being alone. He has a limited pool of resources and expertise. And so should he need money, it may be elusive for him to borrow from banks, from established financial institutions, because they know that this is a loaner, a person who, if they fail to recover funds, he may not be able to pay them. Partnership, now this lady will look for other members. Can be an accountant, an engineer. They bring in their pool of ideas in one. And these ones will come up with what is called a partnership deed, which may be oral or may be written, which stipulates the functionalities of each partner, how much time, how much money as capital must be put in. Okay, who does what, the roles. This for accountants and lawyers is limited to 20. So partners can be active or passive partners. Partners can be limited. So ideally, a partnership is got the following advantages. Number one, we have a larger pool of resource, larger pool of expertise. Decisions are more informed because you have experts. Other advantage of a partnership is they only pay one type of tax, which is simply income or pay as you earn, same as the sole trader. Disadvantage is that it has unlimited liability, meaning these partners are accountable to whatsoever investment they themselves would have put even up to their personal belongings. Another disadvantage of a partnership is that personal conflict is possible to disrupt the partnership. In case of any disagreement as a partnership, they may dissolve it because of personal clashes. And also the decisions are binding upon the partners. If one member wrongly misbehaves, it may be binding upon the whole partnership. Company, now under Cap 388 of the laws of Zambia, allows for individuals to protect their interests of their investment called a share. Once they invest into a company, they are separate from the business itself, meaning the business can sue or be sued. If a director, even if he is the absolute owner of the business, must he misbehave, the company can sue for abuse of the position. So advantages of a company are several. Number one, there's limited liability. That is called limited company, meaning if the shares that you invested in a company are exhausted, the creditors may not touch the belongings that individuals may have. There's a larger pool of resources because people who buy shares may have different financial muscles. A company also may have an advantage because banks will be more confident and open to giving companies rather than sole trader or a partnership. Disadvantage is that it may also attract competitors to buy shares because it is not what? Protected, except when we're dealing with the two types of companies, of the private and the public limited. A private, you sell secretly the shares, meaning you can choose who can buy. At a public company, these shares are traded on a stock exchange, like the Osaka Stock Exchange, meaning even competitors can buy. So disadvantage also is that it is tedious and complex to come and costly. You have what we call the Articles of Association, the Memorandum of Association, and this whole tedious process is of a company. You also pay not only one type of tax, but also two corporate tax as well. We also have a cooperative, which is also formed. So these cooperatives also have their own characteristics. Any questions so far? Are we moving together so far?
Yes, sir.
Okay. Anyone who's behind? Hope we're following. Let's do a quick, can you remember? All right. So a partnership comes up with a constitution that stipulates what a partner must do, the responsibility, what type of constitution, what type of document do they sign? The partnership signs up a document which stipulates what the responsibilities of each partner may be. What type of document is that?
Is it not a memorandum of understanding?
They're close, but not for a partnership. Memorandum is for a company.
Maybe terms and conditions of
It's a partnership deed. So I mentioned the sole trader, only one-man business. Normally does the running up and down, plays an active role, may have employees. So we talked about the advantages and disadvantages, unlimited liability, lack of continuity, and possibility of wrong decision because it's alone. Partnership, we said here, a sole trader may be limited, so two or more may join. So in a partnership, we talked about the advantages that it may form a partnership deed, which looks at how much money, what jobs they do, how many hours, how to share the profits and losses. So this may be formal or informal, meaning oral or written. Examples could be accountancy, law, and medical firms. The advantages, we said, they pool resources, they pool skills, they share the risks, There's no need for auditing. There's no need for publicly disclosing their information. The form of account is not regulated and easy to increase or reduce capital. Its advantage, I said, has unlimited liability. There's too much dependency on the capital financed by the partners. The partnership ceases when a new member joins or leaves or dies. The owners of the business are partners, so they'll be treated as one. If one wrong decision is made, it is binding upon all. And also, it's not easy to sell a partnership. We went to a company where we said this is a legal person who is treated as an individual. The persons who buy shares are called shareholders. And these ones may be subdivided into a limited or a private. It has a board of directors who report to the shareholders. What is a public company and what is a private company? So a private company ends with the word limited, LTD. So here directors and shareholders are required to have a minimum of 2. So in this private company, we are not asked to publicize our shares publicly. They secretly sell their shares. When we go to a public company, we say these ones can sell their shares on the stock exchange, and it ends with PLC. PLC means a public limited company. And they have a minimum authorized capital of 1 million. So if it winds up, these are sufficient to paying up the creditors. So we talked about the advantages and disadvantages. Advantages for these companies that they have limited liability. It's easier to raise funds from the shareholders because you sell shares. There's no limit of the number of shareholders. You can have as many as can be. Separate legal entities from the owners, meaning they can sue those that may abuse their office. Transfer of shares is easy than the complexities that a shareholder or a partner may have. Its advantages are that the accounts have to be audited at a cost. They need to publicize their information in the press. Limited liability company will have to comply to what we call accounting standards and legal requirements. And lastly, and not the least, issues of share is regulated by the law, so it is difficult to reduce share capital. So we talked about users of financial accounting information. Can you remember who are the users of accounting information? We have the internal and external. Can you give me examples of internal users of accounting information? I mentioned this already.
I think under internal users, we have got partners if it is partnership.
The employees, yes. Users of internal information. Anyone else? I mentioned the users of accounting information, internal and external. Yes, Mali.
Sorry, I've just joined in. What's the question?
Who are the users of accounting, the internal users and external users of accounting information?
Okay, so the internal users are the directors, employees, managers, and also the external users are the shareholders, the analysts, suppliers, and the like.
Okay, so internal users, we have the managers, the directors, the auditors, the employees. External users, we have the lenders, shareholders, government, local authorities, the analysts, the journalists, competitors, suppliers, external auditors, customers, general public, trade unions, also potential investors. These ones are examples of external users. So to explain each of them, the shareholders really want to know the current and future profits because they're the ones who put in money in terms of shares. So they want to have security of the investment to be reviewed. So they need to have that basic information of accounting. So as potential investors, if I want to put money in this business, I must be secure. Then the employees, we need to know if the employer can offer secure employment and possible pay rises. So these are the employees. So if we're looking at trade unions, we're going to look at the number of employees. They want to see whether they may have bargaining power. All right. Then when we go to our customers, they also want to know whether this institution has a going concern. Okay. So they want to know whether this institution may be supplying them. They don't want to run out. They don't want to engage a company that will run out at some point. The customers, the suppliers also want to know whether they'll be paid. The competitors also want to make informed decisions. Questions this far? If there are no questions, we continue. Government for tax purposes. All right. So managers, they want to use that for planning and control. The board of directors for strategy development. The lenders, they also want to know whether they'll be repaid. So all these are custodians of this information. The journalists for their news, the general public to see whether they are going to be corporate social responsibility, whether they'll be benefiting. For researchers, you and me would want to use that for research data. For tax, it is going to be used to assess whether they want to know how much can be paid. So this is what financial accounting information is important. So we also have what is called management accounting. I'll discuss that later on, but what you need to know is that for internal use, management accounting is used to aid management for planning and control, whereas financial accounting is used for decision making. So we go to Unit 2, where we're going to look at the conceptual framework. Under conceptual framework, we're going to look at the standards that are there that have been put to regulate our accounting system. So we have what we call the national company legislation. This is part of the regulatory system. We also have what we call the stock exchange rules and international financial reporting standards, which you often hear as the IFRS. So these are standards. We don't, in accounts, just prepare statements or documents. They need to be subjected to these standards. So what are these accounting standards? They are the authoritative pronouncements that can explain how to deal with certain accounting problems. For instance, how to evaluate closing stock, how to evaluate or measure property and plant. So these ones have governed and given us a standard way, wherever you go, whether it's in Zambia or in the States, how to evaluate such. The rules also give us why we need accounting standards, to have a common form like we do when you're going country to country. The sockets that we use maybe in Zambia should be the same as sockets that you use when you go to Nigeria. Same with accounting standards. When you're going to report as an accountant, you can work anywhere because these are common standards. So they look at the content and the form. So there are rules that govern accounting standards. So these are the rules that are there. So there's accounting standard 1 up to 20, and 1 up to 37. So I'll not go into depth, but just need to know that they are all under a framework. A conceptual framework for reporting is a comprehensive set of concepts that are used by accountants to record international accounting. So they also help provide concepts and also give guidance for decision-making to the board and when developing standards. Of course, from time to time, they're revised. We had one in 2018, another one revised in 2020. As time goes by, they keep revising to suit the changing world. So therefore, the conceptual framework is important because it helps the board of directors or the board to develop the required accounting standards. It also helps our people who prepare financial statements develop something that is consistent, to which may apply to all other countries. It also helps parties to also understand as they interpret these financial statements. You and me must be able to understand the financial statements in Zambia, in America, when they come up with a standard. Now, I want to look at another key part of this, where we talk about the objectives of these financial statements. These financial statements are important and useful to the users for what? For decision making. So we look at elements that are included in the financial statements. So we have assets. What are assets? If I could ask, I explained this earlier on. Assets are simply what the business owns. Liabilities are simply what the business owes. Equity will come in form of what? Share capital, accumulated reserves, and other reserves. Revenues, we'll look at what gains the company may have. Expenses are simply the operating expenses that a firm, an organization may incur. You may have expenses like salaries, administrative expenses, rent, rates. All these are examples of what? Expenses. We have gains and losses.
You said equity, under equity, what do you say?
All right. So the question is, what is equity? Equity is simply share capital. These are simply shares. So shares are simply called equity because we have two types of equity. We have what is called common stock, which is equity that is paid for by what we call ordinary shareholders. So these ordinary shareholders come up with share capital, which is called equity. Then we also have preference shareholders who buy preferred stock. So briefly, to delve in these types of shareholders, there are people we call speculative shareholders, like preference shareholders. When they're buying shares in a company, all they're interested in is a sure return, which is called a dividend. So in a year that a dividend is declared, they are the ones who are first paid, after which the residue is paid by the common stockholders. These are the real owners of business. Their shares are called equity. They are the ones that have voting rights. They make decisions. Preference shareholders don't make decisions because they are speculative. They only want to what? To make a return. So in a nutshell, equity is simply share. Share. Is that clear?
It is.
All right. Okay. So we now proceed to explaining the definitions. Assets represent an economic resource which is controlled by a result of past events. An asset is simply what we own. This resource that gives us potential rights of economic benefits like cash, debtors, motor vehicles. These are assets. Assets can also be stock, prepayments. These are assets. So we have two types of assets. We have assets that we call current assets. These are assets that can be converted into cash into the short period of time. So current assets, we may have cash at hand, cash at bank. We may also have debtors. Who are debtors? People who owe us money. So if some creditor wants to collect money, just say somebody owes me, he's got a debt. We have repayments. We also have stock. If we're dealing with selling goods, we also have stock. So these are called assets, current assets. We also have non-current assets. These are also called fixed assets, things that we own, like land, motor vehicles. These are meant for use in a business. All right, buildings, they are called what? Non-current assets. So we also have liabilities. This is simply an obligation to pay, a responsibility that we have to remit. So these also can be current and non-current. Current are simply in Congolese is that we can pay within a period of a year or less, like loans, creditors, owing wages, owing electricity, they fall within a year. The non-current liabilities, these are long-term liabilities like a long-term loan, a debenture, a bond, all these that fall a year and above. They're called liabilities. So these are all called elements. We also have expenses. Expenses will decrease the asset in value or will increase the liabilities, because when we have an expense like a salary, we have Congolese telephone bills, depreciation, and the revaluation of assets. These are all expenses. Revenue and income increases our assets. So our revenues may come in cash sales, credit sales. These are income. We also have equity. Like I said, when you put money into a business or you start a business, we call it capital. So we have characteristics of
So, Mr. Collins,
yes, please.
what's the difference between depreciation and accumulated depreciation?
So in a year, you have a car, which is 100,000. So in year one, 10% of 100,000 is 10 pin. So you keep incurring 10 pin. Year one, 10 pin, year two, 10 pin, year three, 10 pin. That is actual depreciation. But if you are adding like cumulative, so year one, 10 pin, meaning year two, you have 10 pin plus 10 pin, which is 20 pin, it has accumulated. Year three, 20 pin plus 10 pin is 30. So it keeps adding on. So as a term, accumulated, it is an added on depreciation, the current debt. So it's a total depreciation you have incurred. What is depreciation? It is a wear and tear of an asset. Is that clear?
All right, thank you.
All right, so I'm trying to summarize the first 3 units so that by the time I'm starting at 20 hours, we can look at the calculation. So these are fundamental issues. So we have fundamental qualitative characteristics and enhancing qualitative characteristics. The fundamental characteristics look at the relevance, the faithful representation, and enhancing, we have comparability, timeliness, understandability, and verifiability. Now, what are these characteristics? So when we're dealing with fundamental qualities, number one, information must be relevant, and information must provide a faithful representation of what it purports. So these are called fundamental in the sense that they, number one, seek to give a difference to decisions that are made by the users of financial accounting, because information that is relevant is applicable, it is useful, it is capable of making a difference in decisions. Faithful representation means that whenever you're providing information, it must represent the true substance of what it purports. It must give the maximum possible extent, the neutral, the free from error information. It must give you faithful. That's why we have auditors, to see that the information you're providing is nothing but the truth. Are we together so far?
Yes.
Okay, so that is about the faith representation. Then we go to the enhancing characteristics. Information must be understandable. It must be timely. It must be comparable. It must be verifiable. What do these characteristics mean? In terms of understandability, it means that when you're presenting financial information, you, the basic user, must be able to know, okay, we made a loss, we made a profit. It must give the basic user information that he will use to make decisions. It should be understandable in the context that it should not be left out of financial statement due to difficulty in interpreting it. It must be verifiable, meaning it must help the user to fully and faithfully represent the true value. It must be verifiable to the extent that you can produce evidence and data that will support your presentation. It must be comparable. With time, you need to give trend to say we are doing fine or we're not doing fine. So it must have a comparability aspect through time so that we are able to evaluate our performance in terms of growth. It must be timely. Information that is timely will be provided to be useful to the user. Sometimes information that is provided at a time becomes useless because you beat the aspect of relevance. Timeliness is important in accounting. No wonder ZRA gives penalties for people who fail to fulfill their timely obligations. So there are underlying assumptions that underlie the preparation of financial accounts. Yeah, number one, the reporting entity. Number two, going concern. Number three, monetary entity. Number four, periodicity. So accounts assumes that whenever you're preparing the records, you must assume that it may have a going concern. Right now, you may start with a helicopter, but see yourself as having what? An aeroplane. Now you may start as a tuition center, but see yourself as being a university. So as a going concern, you will need to, it's an assumption that a business will continue to operate in a foreseeable future. Monetary assumption simply expresses the concept that you should always report in currency form, in monetary form, like I mentioned in the preamble. We're not using the Stone Age, where we're going to use barter or ivory to represent the value of the firm. We're using money as currency, dollar, which has a currency phrase, for instance. The reporting entity assumes that we need to not necessarily use a legal entity, but we should assume an entity to be accounted for separately from the other. So the separate entity says that the business and the person are two different persons. So if the household who is managing this company has erred, you cannot go to the person to assume that even their house is taken. So these are separate entities. The periodicity or time period assumes that the life of a company should be divided into periods such as months and years. So when you're reporting, you may report every semi-annually or annually or monthly. You need to give your reports. So these ones will give us what we call accounting principles. So these principles will include the cost, revenue recognition, the matching concept, the full disclosure concept. So these concepts, to break them down, imply as follows. Number one, the revenue recognition says we can only recognize revenue when it's earned, not when, so the process will not necessarily be in cash, but we measure revenue by cash received plus the value of items received. So when you sell a good, you need to record that you made a sale, whether money has come in or not. The cost principle here assumes that information should be based on the actual cost. So if you bought land at 50,000 and it has accumulated to 100,000, leave it at 50 because that is the cost that you bought it at. That is a concept or a principle. Then the matching principle assumes that you need to record expenses incurred to generate the revenue. So the matching concept is also called the accruals concepts. It says a company must record its expenses incurred to generate the revenue. So this also means that even if you have not yet paid salaries, you need to record them as incurred because you've enjoyed the benefit of the workers. So this is called the matching or the accruals concept. And the full disclosure principle simply assumes that a company is required to report the details behind the financial statements. So this is the theoretical part that you needed to know. I tried to simplify it as much as I could. Then finally, we go to the accounting process. So at 2030, we'll be looking at now Unit 4, which looks at the actual accounting. So the accounting process has a cycle, which is called the accounting cycle. The steps in accounting, the posting of transaction, the accounting equation, and double entry system. So it is assumed that whenever we're dealing with accounting, the inputs are the source documents that we start, like the receipts. We take it into the accounting cycle to process the receipts. When the receipts are produced, the output will be a financial statement like a balance sheet, an income statement, or a cash flow statement. When this is produced, the management accountants will take it for internal use. So the accounting system works like a computer, garbage in, garbage out. So the first step is we analyze the source documents. So like the receipts, the credit notes, the debit notes, then we journalize them, open journal accounts. Then we start posting them into the ledger and the general ledger. Then we post them to the trial balance, which finally it gives us to take them to the final statements. So we're going to look at the books of accounts. The books of accounts include the ledger. We have what we call the general ledger. The general ledger is simply a book used to record transactions before recording them into the accounts. This general ledger is often used in a T account. So it is used to record a double entry system. For every debit entry, there should be a corresponding credit entry. So the process of copying transactions from the journals to the ledger is called posting. These are the terms you need to familiarize yourself with. So an account is simply a record of an increase or a decrease in a specific asset, an increase or decrease in a specific liability, an increase or decrease in equity, in revenue, in expense item. So we're going to look at how to post issues in a ledger. So a general ledger simply contains all accounts. So we have a ledger, which is simply a book of accounts in short by definition. So there are several types of ledgers that you need to know. There's what we call an asset account, a liability account, an equity account, an expense account, a revenue or sales account. All these are types of accounts that are found in a ledger. The asset accounts usually look at the assets like the cash, the debtors, the motor vehicle. So we open specific accounts for each of them. A guide that we always use is the word payrolls. Payrolls gives us a picture of how to classify whether we're going to debit an entry or credit it. So accounts works on a preface which says we always debit whatever, debit the receiver and credit the giver. So to increase our purchases, we are going to debit. To increase our expenses, we debit. To increase our assets, we debit. The opposite will reduce them. So to reduce our purchases, we credit. To reduce our expenses, we credit. To reduce our assets, we credit. Then to increase our revenues, we credit. To increase our liabilities, we credit. To increase our sales, we credit. Payables. So we've talked about the 5 types of accounts, the assets accounts. So all assets have a debit balance, be it cash, debtors, motor vehicles, and expenses. Liabilities talk about what the business owes. So they always have a credit balance. Equity, capital, they are revenues. They also have a credit balance. So we have share capital and retained earnings. All these have a what? Credit balance. Expenses are have a debit balance. Any questions so far?
Yeah, I would like to find out on the aspect of those letters, is it pairs? Yeah, the importance of that, maybe I had missed some point. I didn't get you clearly.
Okay, so PAIRS is an acronym that helps you remember what you debit and what you credit. So most students get to forget the concept of knowing whether to take a transaction, whether we're going to debit it or we're going to credit it. So I'll look at a few questions that will help us understand the concept of deciding whether an account will be debited or an account will be credited. So purchases always have a debit balance, expenses always have a debit balance, assets always have a debit balance, revenues always have a credit balance, liabilities, credit balance, and sales credit balance. So when we're dealing with the accounting system, we always use what is called a double entry. So these are a list of accounts and we identify them on which side they are, depending on what I've talked about. So help me identify. Cash, is the debit or a credit?
It's a credit.
Credit.
It's a debit because it's an asset. We debit it.
Oof.
Oh,
Account receivable. These
That's
are
a debit.
debtors. Yes. Debtors
It's what?
we debit it.
Accounts, eh?
The account receivables. These are like debtors. Okay.
Okay.
We debit because these are assets, money that we own. So maybe let me just take you through simplicity so that you understand how to treat these items. So to start with, you need to understand the accounting equation, which says if you have resources in a business, they should be equivalent to the item that the person who supplied them initially. So our accounting equation, therefore, becomes distributed as follows. The assets that we have in the business should be equated to the capital and the liabilities. So if we have assets, what we own, capital, what was injected, plus the Congoles that we have. So this gives us what we call the accounting equation. Now, I want us to identify transactions that can be produced using the pairs. So on first, let me look at this for now. Let me look at the double entry. I said the double entry system in accounting simply assesses that each transaction must have two entities. One is a debit entry, the other one is a credit entry. So for each transaction, we need to identify what account will be debited and what account will be credited. So we're going to look at a few examples that will help us fulfill the T account. So let's look at the concept of PAIRS. I said PAIRS stands for what?
Purchases, expenses.
So to increase
and
what
assets.
we debit them. To increase expenses, we debit them. To increase assets, we debit. To increase our revenues, we credit. To increase the liabilities, we credit. And to increase sales, we credit. So with that being said, using
Can you just repeat that?
so assets, if we want to increase them, we debit. Expenses, if we want to increase them, we debit. All right. So we're using what? Pairs. Assets, if we want to increase them, we debit. Expenses, we debit. Purchases, we debit. But to reduce the assets, we credit them. We don't subtract. That's how the T account works. So the expenses, if we want to reduce them, we credit them. Then we go to capital. To increase capital, we are going to debit it. To increase liabilities, we debit them. The income, to increase it, we debit it. Now, for you to understand this very well, let me use comprehensive questions. Here we have an example to say Mrs. Moyo started a business called Moyo Limited. So she deposited 5,500 into a bank as share capital. So we need to identify two elements that will help us come up with the accounts. So January 1, Mrs. Moyo started a business and deposited where? 5,500 into the bank. So to start a business, the account that we're going to open is called the capital account. So there's one, which is called the capital account. Then deposited money into the bank. We have another element which we need to identify, which is the bank account. So we have identified the elements. So step 1, identify the element. Step 2, check whether the T account is identified. Step 3, correct the entities into the T accounts. Step 4, make sure that you include the debt. Okay, these ones may not be relevant as much. So Mrs. Moyo started a business called T Moyo account. So we have identified two, the capital account, which is this one, and the Moyo account. And Moyo will come later. We can see the bank account, which is there. So now we said bank is an what? An asset. So to increase our assets, we debit them. So this heading here becomes the element that we're going to put inside here, the entry. So we call this capital. We're going to put 5,500 because we're increasing asset. Then this one is a revenue. So to increase revenue, we credit it 5,500. Let's look at purchase goods costing 540 on credit from TradeKings. Whenever we hear purchase goods, it is called purchases. If we purchase a motor vehicle, if the good has a name, we use that name of the vehicle. Purchase motor vehicle, we open motor vehicle account.
Oh, yeah, I can get you, sorry.
Then costing 540 on credit from TradeKings. So if it was bought on cash, we don't need this creditor because we don't have Nkongole. But everything that was bought on credit, we need to get this to another account. This is TradeKings. So we have two accounts here. Purchase goods, so meaning we have a purchases account. TradeKings, if we bought on credit from TradeKings, TradeKings becomes our creditor. So we're going to open TradeKings account. So remember using pairs, what do we do to increase what? Our purchases? We debit it. So purchase account, we'll put TradeKings in here. 540. Then we go to TradeKings. TradeKings is what? Under liability, it's a creditor. So this title here comes inside there. The same amount, 540. Let's go to another record. We're told that we recorded sales on credit, 450 from Chongwe Council. So there are sales that we had, and there's Chongwe Council. Now, who's Chongwe Council? Chongwe Council is our data because he was buying from us on credit. So payrolls, our data has always have a debit balance. Credit has always have a credit balance. So to increase our data figure, we debit the sales. Sales using payrolls. Remember, to increase the sales, we will credit. So Chongo cancel here, credit. Any questions so far? Any questions so far? Are we moving together? So I want somebody to try paid rent on office premises by check 450. Who wants to try that?
So the two accounts are rent and bank.
Okay, rent and bank, good. So identify,
Then we debit rent and credit bank.
okay, why do we debit rent?
Because we are paying. Then we are paying by bank. We are removing the money from the bank account to pay rent. So rent is received.
Okay, do we agree with him? Do we agree with him?
Yes, sir. Yes.
Okay. So rent is an expense. So we realize that expenses, to increase them, we do what? We debit them. Okay, so he has identified the element that rent is he has identified the element that rent is an expense. So to increase the expense using pearls, we're going to do what? We're going to debit. Okay, so rent account and bank account. So bank is paying out, so it's reducing. So the assets are reducing there. So we're going to credit the bank account. So when we go here, when we go to the bank, and we go to the rent account. So rent, to increase it, we are going to put the bank there, 450. Then when we go to the bank account there, this we're reducing. Ideally, bank, if it was receiving, would have added it. This is the first capital that we had, but now here rent is paying. So what happens? We're reducing the amount that we had in the bank. So what is going to happen is we're going to credit it. Okay. So are we together? Are we following? I want somebody else to help us. Withdrew cash from bank for use in the cash till 800. So this is called a contra entry. Money is being used within the same system. So the bank account is giving us money, which is 800. But the cash account, like at the office, is receiving the same 800 for use for running up. So you always have, for every debit entry, there should be a corresponding credit entry. So this is how we how it moves. Okay. So any questions? So recorded a sale for 180 in cash. So meaning we have two accounts there. The cash account is receiving 180. The bank account is also, so recorded sales 180. So this means that when we had a cash sale, we received cash of 180. Cash is an asset using pairs. But to increase our sales, sales always have what? A credit. So this is what is happening. The sales, to increase sales, we do the credit. Okay, so basically, what I'm talking about is what I'm preempting to be done for our class at 2030. So I'll release you for 15 minutes to just rest, but we'll join again later on. Okay.
All right.
What we are starting from where at 2030, though we are yet to get the whole concept.
So 2030, we are starting from here, the ledger accounts. We're going to look at an exam question on the ledgers, how to post the ledger, from the ledger to trial balance. So I've taken you through all the concepts that you needed to understand for a question. So we're going to look at an exam question now, which has which is coming from the question bank. So we're going to look at this question at shortly. So I'll give you time to rest. So we're going to look at how to answer a question like this one here, coming up with the transactions from what we have learned.
Okay, maybe just go through the what the letter payables means. I was behind P, purchasing, expense, assets, and R, revenue, then A and S.
Liabilities and sales. So that is the acronym for payables. Okay.
So liabilities you debit or you credit.
We credit to increase them. We credit liabilities.
And the sales you also credit.
And sales, yes, we also credit to increase them. Purchases, you do what?
Debit.
The purchases, you debit. Okay, so let's do a quick, can you remember before I end this session of the classes?
Okay.
So quick, can you remember? A ledger is called a book of accounts. Let's mention any 5 types of ledgers that we discussed. Number 1.
Asset account.
Asset account. Number 2.
Liability account.
Liability account, yes. Number 3.
Is revenue, equity.
Yes, revenue. Yes, equity. In short, you're using the term payables to help you understand the particular terms. Okay, so we have 3 entities of businesses. Name any. Number 1.
Also trader.
What's the question, sir?
The sole trader, the business organizations. The sole trader. What else?
The partnership.
Partnership, yes. What else?
A company can be divided into
And the public limited company.
Excellent. So a public limited company has its way of raising finances using the share capital. So we have 2 types of shareholders. Can you mention them?
Is it public?
The 2 types of shareholders?
For the public?
Yes.
I don't know if one of them is the government. I don't know.
No. 2 types of shareholders. We have ordinary shareholders and which ones? And the preference shareholders. Okay. So we'll end here. I'll give you 15 minutes to rest. Then we'll start from there. We'll start with this question. Thank you so much.
Okay.